Welcome to the Stock Market Palantir. Today, we are going to talk about WULF. We're looking at TeraWulf Inc. at what is really a moment of profound transformation here in late November 2025. This company is making a very decisive pivot from being, well, a pure Bitcoin commodity producer, essentially a large-scale SH-256 hashing operation, into what it hopes will be seen as a critical digital infrastructure and high-performance computing, or HPC asset. And this shift is driven, entirely by the explosive, energy-hungry demands of generative AI.
And that pivot you mentioned is precisely why the stock is showing the kind of, manic volatility we're seeing. It's a company trying to shed its history and, take on a completely new identity, and the market doesn't quite know where to put it yet.
Exactly. And the central question facing investors right now is whether this massive valuation rereading, moving WULF from a volatile crypto miner to, say, a potential REIT for digital compute, is fundamentally justified by the scarcity of its execution-ready power and its significant contracted revenue streams. Or is the stock's current intense volatility and pricing just driven by speculative momentum and these unmitigated risks baked into its corporate history? So I'm taking the position that this is a structural bull case. I think it represents a distinct arbitrage opportunity because of their access to scarce energy infrastructure, a position that's validated by some very clear institutional buying patterns.
And I have to say, I fundamentally disagree that the structural story outweighs the operational and, frankly, the historical fragilities. While the AI pivot is, I'll admit, undeniably compelling, conceptually, I maintain that the stock remains a high-beta momentum trade. It is exceptionally fragile. It's burdened by a complex and, let's be honest, a distrusted corporate history. And beyond that, there's critical immediate regulatory opposition in their key operational area that could seriously jeopardize their timeline and just derail this entire infrastructure narrative. The risk for me is just too high to justify the current valuation.
Okay, let's look at why this company commands a scarcity premium right now. The core thesis. It hinges entirely on the scarcity of energized zero-carbon power infrastructure in the U.S. grid. You simply cannot build this capacity fast enough. Their Lake Mariner facility, which is adjacent to the Susquehanna nuclear power station, it commands a premium because greenfield transmission development, finding a new site, permitting it, connecting it to the grid, that faces 3 to 5 year regulatory backlogs. Well, TUF already has permitted energized power in a highly constrained grid zone. That right there is an arbitrage opportunity against any competitor.
I'll acknowledge the scarcity of the power asset, I will, but that scarcity only means something if management can actually execute. And execution, frankly, is where all my skepticism originates.
But the financial pivot is tangible. It's already underway, which proves execution is happening. Q3 2025 confirmed the commencement of these high-margin HPC revenue streams. We saw $7.2 million recognized in that quarter alone, backed by contracts with hyperscalers like Google and FluidStack. That is cash flow stability. That fundamentally shifts the valuation model away from the boom and bust cycle of Bitcoin. And moreover, the strategic financial cleanup they just undertook in November, the mandatory preferred stock conversion, it simplified the entire capital stack. This move removed the messy preferred overhang, which had been depressing the valuation and, keeping major institutional funds on the sidelines. They're essentially telling the big investors, look, we've cleaned house, we're ready to play with the big boys now. This signals corporate maturity.
I see why you emphasize the capital structure cleanup, I do. But that whole maturity narrative is, I think, thoroughly undermined by the context of the company's past and its present trading behavior. The stock's history is rooted in heavy speculation, particularly around that complex 2021 Iconics reverse merger. When a company uses a reverse merger, they're bypassing the traditional scrutiny of an IPO. And in this case, the maneuver resulted in insiders emerging with over 60% voting control. That structure, it fuels a persistent and very potent grift narrative on retail platforms, where skeptics just fundamentally distrust CEO Paul Prager. They view the AI pivot as merely the latest, most profitable buzzword chase. So there's a trust deficit they have to overcome. And beyond that, we have to address the current financial reality. Despite these promising contracts, 85% of their current revenue is still from Bitcoin mining.
That means their near-term cash flow? And critically, their debt servicing capacity, they remain highly vulnerable to any significant crypto price collapse. You can't just ignore that legacy correlation yet, no matter how good the future contracts look on paper.
Okay, let's address that volatility head-on by looking at how sophisticated capital is actually positioning itself. If we analyze the market structure, the high levels of off-exchange or dark pool trading volume, which was consistently between 36 and 50% in November, that signals aggressive institutional positioning that is being intentionally cloaked from the public order book. These institutions are accumulating size stealthily.
You've cited the high volumes, that's true, but the interpretation is key here. How does that signal accumulation rather than just, general institutional trading volume? Dark pools are used for everything.
Well, let me be specific. Look at the two-day period around November 24th and 25th. The stock surged aggressively. It posted gains over 10% each day, and the dark pool volume remained intensely elevated, between 36 and 41%. In market mechanics, this is a classic accumulation signature. It means institutional buyers were so aggressive, buying blocks far larger than retail orders, that wholesalers were actually forced to internalize massive order flow just to satisfy that sustained, aggressive buy pressure without moving the price even higher, faster on the public exchange. Wholesalers do this because they're obligated to fill at the best price. The fact they had to internalize so much volume during a sharp rally proves that institutional buy demand was overwhelming the available supply. Sophisticated capital is actively accumulating large positions here because they're anticipating the structural re-rating that is coming.
I have to say I fundamentally disagree with that conclusion. That's an interesting data point, but I would frame the function of dark pools very differently, especially in a volatile, low-float stock like WULF. While high off-exchange volume can signal accumulation, it is equally effective, if not more so, at facilitating distribution without causing market panic. I mean, just think of November 14th. Nearly half of all trading, 49%, happened off-exchange as the stock dropped almost 6% following that Q3 earnings miss. That data strongly suggests institutions use those dark venues precisely to offload significant positions without causing a flash crash, effectively managing their exit and minimizing their losses. The high volume just confirms volatility, not necessarily a directional bet. And furthermore, we need to talk about the high off-exchange short volume. For example, 8.3 million shares were reported short off-exchange on November 25th. You claim this supports demand, but often, especially in these high-velocity trading assets, this just represents market makers shorting for routine liquidity provision. They're just stabilizing the price swings they cause. This underscores the high-volume, high-velocity trading nature of the stock, which necessitates more market maker intervention, confirming its status as a trading vehicle, not some stable infrastructure play.
I'm not convinced by that line of reasoning because you're separating the short volume data from the price action context. When the price is rising aggressively, as it was on the 24th and 25th, the appearance of high off-exchange short volume is typically not institutions positioning for a drop. It's market makers shorting simply to keep up with the overwhelming flood of retail and institutional buy orders that need immediate fulfillment. They're taking on inventory risk to provide liquidity, so they're effectively shorting into buying pressure. The existence of high short volume during a rally confirms massive underlying demand from buyers rather than confirming routine liquidity. Sophisticated institutions know the re-rating is coming, and they're willing to take these risks to get their position before the public catches on.
All right, let's shift focus from trading mechanics and speculation to the foundational operational mechanics, because this is where the execution risk is really centered. The most critical risk is local regulatory pushback in upstate New York. The shift from, low-heat Bitcoin mining sheds to much hotter HPC capacity requires massive cooling infrastructure. This means a new or expanded application to withdraw and discharge millions of gallons of water from Cayuga Lake, and the local opposition in Lansing, New York, due to fears of thermal pollution, of heating the lake, is intense.
This local NIMBY not in my backyard risk has led to proposals for data center moratoriums in the area. This isn't just some political headache. This is a genuine tail risk that could severely delay the energization of that Google-backed capacity. And if they fail to hit those deadlines, it could potentially trigger penalty clauses in those highly valuable Fluidstack and Google contracts. The contracts sound fantastic, but if you can't energize the hardware on time because a water permit was rejected, the entire thesis just collapses.
I see why you think that. And I agree that local opposition is a significant friction point that requires careful navigation. But let me give you a different perspective on how the scale of the contractual backing fundamentally mitigates that tail risk. The sheer magnitude of the long-term contracted backlog, we're talking $6.7 billion over 10 years, coupled with the undeniable Google credit enhancement, well, it means management has an overwhelming incentive and the financial muscle to solve this problem. This high-value backing already allowed them to secure $3.2 billion in senior secured notes at a significantly lower cost of capital than any of their peers. They have the financial resources, the legal teams, and the reputational incentive necessary to navigate and, I believe, win local legal and regulatory battles. Yes, the NYSDF environmental conservation permit is crucial, but they are not going in under-resourced. And moreover, the company is already strategically mitigating reliance on New York through diversification. They've explicitly mentioned the new 600-megawatt potential at the Abernathy joint venture site in Texas. So they aren't putting all their eggs in the Cayuga Lake basket.
Financial muscle doesn't guarantee a timely environmental permit, though. Especially not in New York, where political pressure is very high on issues of clean water and climate change. If the DEC denies the increased water withdrawal permit, the expansion of Lake Mariner is capped, period, regardless of Google's financial backing. Those $6.7 billion in contracts rely on that capacity coming online. The regulatory complexity, which involves proving there will be no thermal pollution detriment to the local ecosystem, it threatens the immediate operational timeline. And we also need to consider the difference between a Bitcoin mining shed and a Tier 3 AI data center. Tier 3 requires N+1 redundancy, multiple power paths, highly sophisticated liquid cooling loops, humidity control. This is exponentially higher engineering complexity than running a basic SHA 256 operation.
Any failure to meet the rigorous service level agreements, the SLAs, required by Google could seriously damage their reputation as an infrastructure provider. This transition isn't just about plugging in new machines. It's a massive operational learning curve that is highly sensitive to this regulatory friction.
Well, this discussion of contracted capacity and complexity leads us directly to the valuation question, which I would argue is structurally simple and unavoidable. The market is being forced to re-rate this company. Wall Street assigns a 20 to 25 times EBITDA multiple to stable contracted data center revenue, the kind of multiple enjoyed by data center REITs, compared to only 5 to 8 times for volatile commodity-based mining revenue. This re-rating is structurally necessary because the market is now pricing in the replacement cost of its energized zero-carbon capacity, not just its current volatile earnings. You're paying for the asset and the contracts, not the legacy volatility. The recent wave of analyst upgrades projecting targets in the $20 to $26 range and the successful clearing of that critical $13 preferred conversion threshold, they confirm that institutional conviction in the AI infrastructure pivot is now the dominant driving force. The market has recognized the scarcity premium, and the valuation has to follow the new business model.
I'm just not convinced by that line of reasoning because you're arguing for a valuation based on a target state the company has not yet achieved operationally. While the long-term contracts are, yes, promising, the reality of the engineering complexity means the transition is far from complete. As I mentioned, successfully running a Tier 3 data center for advanced AI requires a mastery over liquid cooling and redundancy systems, something their legacy Bitcoin operation just did not demand. If they fail to meet those stringent Google SLAs, if their uptime dips or their cooling fails, the reputational damage is immediate, and that theoretical 20 times multiple just evaporates. Until the revenue mix stabilizes, meaning until that 85% Bitcoin mining revenue drops substantially and the HPC revenue proves itself resilient, the risk remains that the stock will be treated as a highly leveraged high-beta vehicle. It'll be easily susceptible to market rotation
or a Bitcoin downturn, irrespective of any analyst price targets. The price action you're citing is retail FOMO fueled by a compelling narrative, but the foundations, they're still being poured.
But that risk of execution failure is precisely why the institutional capital we discussed is willing to position itself stealthily right now. They're willing to accept the current complexity for the future value of the underlying asset. The replacement cost argument is paramount here. You cannot find another publicly traded company with this level of immediate access to permitted zero-carbon power capacity adjacent to a nuclear plant. If they solve the cooling issue, which their senior secured funding gives them ample resources to do, the upside from that 20 times EBITDA multiple far outweighs the current execution risk. The company is strategically de-risked by their clients, even if they are operationally complicated.
But the operational complexity is the risk, especially when it's tied to the legacy management and the distrust that persists from that iconic merger. Investors are being asked to believe that a management team that historically optimized for rapid, less regulated crypto mining can suddenly deliver the precision, the compliance, and the environmental sensitivity required by hyperscale AI clients and upstate New York regulators all at the same time. That's a huge, huge leap of faith, and the current volatility suggests that while the narrative is strong, the skepticism about execution remains very high.
To summarize my position, WULF is making a difficult but, I think, strategically necessary pivot. It's leveraging its scarce permitted nuclear power access into substantial, contracted cash flow backed by hyperscale clients. The institutional accumulation observed in the dark pools suggests sophisticated capital is already positioned for the structural re-rating from a volatile miner to an essential piece of AI infrastructure, driven by the scarcity premium of power capacity that no competitor can match quickly.
And conversely, I believe the company's trajectory is, yes, compelling, but its current valuation is built upon a powder keg dynamic, high short interest, retail excitement, and unproven execution in a highly regulated and locally contentious environment in New York. The significant operational learning curve and the political risks tied to water usage remain the critical variables. They will determine if WULF achieves its infrastructure potential or remains trapped as a volatile, high-beta momentum trade subject to management's historical baggage.
The core investment dilemma here really forces listeners to weigh the undeniable premium of existing power scarcity against the very high execution and regulatory complexity inherent in their current operational path, especially in upstate New York. It is truly a stock sitting at the intersection of a mature crypto cycle and the emerging AI infrastructure boom. Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.